Welcome to Nasdaq Trade Talks. I'm Jill Malapndrino, global markets reporter at Nasdaq. Joining me is Emily Bowersock Hill, founding partner of Bowersock Capital Partners, a sanctuary wealth partner firm, to discuss proactive tax strategies as it relates to your portfolio as spring signals a fresh start to take stock and refocus. Emily, it's great to meet with you. Welcome to Trade Talks.
Thank you. Happy to be here.
And thanks for joining us. And many of us have filed our tax returns or extensions at this point in the year. Why are May and June optimal times for portfolio reviews?
Well, this year's a little bit of an exception, obviously, because the tax deadline has been extended. But we like to meet with accountants in May because the tax return has just been completed. So we have a thorough view of the previous tax year and can learn, essentially learn lessons from how we did things that year. And in light of the tax law for 2021, we can say, what could we do to be more tax efficient in the upcoming 9 months? And May tends to be a good time for accountants because they've just finished their, it's a little bit of a slow time in most years.
What type of funds would you recommend removing as you do your spring cleanup for your portfolio?
One thing we've noticed especially in the last 5 years, is huge amounts of assets have moved from actively managed mutual funds to passive funds. The number of mutual funds that are issuing significant capital gains distributions in November and December has increased. And there tends to be a pattern, especially with funds that have significant outflows, of basically issuing higher and higher capital gains distributions. And a lot of clients think, well, don't I want capital gains distribution? And the answer to that question is no, because it's, you want to be able to control the capital gains that you realize. So we try to identify the funds that have fallen into a pattern of doing that and move to more tax efficient investment strategies.
In addition to retrospective tax review, what type of tax and investment goals do you recommend identifying for the following year?
Well, having just completed the tax return, we usually have an idea of what income tax bracket a client will be in for the current year. And so we can establish we like to establish a capital gains tax budget. So what's the ideal amount of capital gains we would like this client to realize in this tax year? Second of all, is this a good year to make a significant charitable donation? And if so, what amount would be optimal? Would this be a good year to convert traditional IRAs to a Roth, for example? And then finally, we look at someone's family gifting strategy. For people that are making gifts to children, we want to review, is this something you can still afford to do from a financial planning perspective? And, what amount of gifts do you want to make this year and to whom? And we'd like to do it in the spring because I really hate scrambling around the last minute. And some of the strategies that we use, by the time you get to November, it's pretty late in the day to try to accomplish them.
So Emily, I want to go into capital gains a little bit more for the benefit of the audience. We just went through a tough year with the pandemic. Aren't capital gains like a good problem to have, right? Or help us understand that a little bit more.
Yes. Okay. So, capital gains, there's depending on your tax bracket, there's an optimal amount of capital gains to realize. So for example, if you go above a certain threshold, there's an additional 3.8% tax that could be levied on your gains. Most taxpayers are in the 15% federal capital gains tax bracket. If you go above a certain threshold, you could trigger the 20%. And so you're conceivably facing an additional 9% tax if you don't control the amount. So there's nothing wrong with capital gains, but you want to have control over the amount you're realizing, how and when.
Got it. That's an important distinction to have. And to my next question, I would imagine this can be overwhelming, especially for folks who may not understand the financial process as well, or the tax codes as much as they should. Is there a lot of work that the client has to put into this to make these changes happen, or do you and their accountants guide them throughout the process?
clients, if we're doing our job right, clients need to do very little. This is something I want them to understand what we're doing, but it's critical for us to have a very good line of communication with accountants. And one of the things that we have concluded over the last 5 to 6 years is if we handle this right with the accountant, we can increase tax efficiency enough that we can offset, in many cases, more than 50% of our cost to the client. So the answer is clients do very little. And in fact, sometimes I don't think we do a good enough job of letting them know how much work is going into it behind the scenes. That's something we as a firm need to improve on.
All right. We appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malapndrino, Global Markets Reporter at Nasdaq.